There are a lot of cross currents here. There are a lot of things for investors to evaluate and to assess, and none of them have easy answers right now, whether it's the impending land war in the Middle East, whether it is earnings, whether it is what the Federal Reserve does next, whether it is whether the marginal buyer shows up for U.S. Treasuries. How are you advising clients right now?
Scarlett, more cross currents than usual. Rule of thumb is the risk that ends up getting you the most is the risk you don't anticipate, like COVID 3.5 years ago. As we sit here today, with more global uncertainty with war, I still think the biggest risk to the markets is inflation not being contained and interest rates having to stay too high too long. That would still be my number one risk as I think about portfolio construction for securities or asset allocation.
What is priced in right now in terms of the inflation picture? That the better than expected growth we've seen in the economy, the resilient consumer and consumer spending will lead to some kind of sustaining of inflation or perhaps even a pickup?
I think today's a great example. We're starting to see more breadth, more participation. The Bloomberg Magnificent Seven is to be noted, but they won't keep going up forever. You'll start to see the average or the median company go higher, and frankly, we need it. While the S&P 500 is up 13%, 14% year to date, the median 250th stock in the S&P 500 is roughly flat. That tells me that more breadth is on the way. It's going to take time to unfold. But that, I think, will be the story as we mark the end of this year and really move into next year's market environment.
So, David, how is the Federal Reserve looking at these moves? Because the bond market had been doing maybe just a little bit of work for the Federal Reserve, and now we have sort of 2 weeks before the Fed needs to make its decision. November 1st is the meeting. So does the Fed decide that it needs to go again this time around, or that it's okay to continue holding?
Heaven forbid I ever advise the Federal Reserve Board, but I would contend, and consistently so for the last couple of years, they were too easy, too long. Now with M2 money supply growth being negative 4 to 5% year on year, it's time for the Fed to sit back, watch how the higher interest rates and the tighter money supply growth plays out. Inflation, it's in the 3.5% range, probably headed to the high twos. I think the best thing the Fed can do is just sit back and watch to see what the tighter monetary policy is going to do to the economy. I'll still believe that corporations were good at extending debt and locking in low-cost rate debt. So are consumers. And in the end, the economy, and we'll see with third quarter corporate profits, they'll find a way for good companies to deliver shareholder value. The Fed should simply sit back and wait.